So far as investing is concerned, I think I don't even know the stock price of Hindustan Lever HDFC Bank because I have no interest in those stocks anymore. And I think Lever is down the same over a year or so thereabouts, right? So we were just discussing, at least that's my view, that these are yesterday's trades. The trade has moved on, and in markets, the only thing my 30 years of investing has taught me is that you have to keep moving because no theme is a permanent theme. Themes keep changing, and the theme that now exists in India is really the small cap space. And I have said this publicly that many times that I don't see the Sensex or the Nifty giving you outsized returns. But on the other hand, if you go the small caps, I'm telling you, I am spoiled for choice. I have more opportunity than I have money. It is insane the amount of companies who either have come up in the last couple of years or existing old line companies who now realize that they cannot do business the old way. They need to change and improve. And yet the valuations are so undemanding, so undemanding. I mean, I have found companies which are trading in single-digit multiples with at least 12 months outlook of 20, 25, 30% earnings growth, maybe 2 years outlook of that much. And therefore, my buffet consists really of the scraps from the rich man's table. So the HDFC banks and the levers can belong to Prashant Jains of the world because they have the size of asset which obviously don't have personally. They have to buy those. Fortunately, I don't have to buy those. And they have worked fantastically well in the last year, 2 years. It's very simple. When we started our careers, there was no internet. Okay, so but the method is this: that most retail investors will not have management access. I mean, let's accept that's a challenge for them. Okay, but without that too, running basic screeners, okay, is this very simple hack to get to a list of companies. Okay, tools are available online free of cost. I mean, I'm amazed the amount. You don't need a Bloomberg terminal anymore. I mean, at least if you're doing just India, amazing tools online. Even I, the professional investor, I use them, a lot. You will find if you do basic good quality screeners, come across 5, 10, 15 names. Then a lot of the information today, thanks to our regulator, is so publicly available. It's fantastic. There's no longer that little cozy club of giving out information selectively to analysts. Every presentation up on the stock exchange website in real time. Managements have to address everybody. They cannot pick and choose that I will only talk to 5 analysts or 5 fund managers. No longer that little cozy club. It's such an open information flow today that I'm amazed at the level playing field that our regulatory mechanism has given to small investors. It is fabulous. Sure. And believe me, it's not there in other parts of the world. I can tell you, it's still, even in the US, it's still a highly closed club, despite regulations having changed. Here it is open. So therefore, you have screeners, you have the stock exchange websites which give you a lot of the real-time presentations. After that's where the thing is. That ultimately this game works on picking 25 good stocks. In my view, we'll never pick 5 great because you don't know what's going to work, what's not going to work, right? You pick a little portfolio. If a sector looks good, I remember back in the 90s when the IT sector came into its own, we had no idea whether Infosys was going to be the winner or TCS wasn't listed, but Wipro or Satyam or a couple of other companies. So we went and bought all of them because the sector looked good. Oh, there are many. So by the way, ESG is an amazingly important thing to look for. There are debates around the G part, but leave that aside. That's an important consideration. And again, there are tools and metrics which can tell you that on the G part. But the E part, which is the environment, I think for a country like India, which has neglected it for a very long time, that's going to be a big thrust area for the government. It already is. And more importantly, if you look at the orders coming from the National Green Tribunal, they are draconian. They shut down plants like that. There's no longer the option of dumping effluent into the backyards or polluting the rivers. So companies that help clean up the environment or help solve waste, industrial waste or plastic waste or things like that. So I think that's a great area to be in. If you can find 5, 7 companies, I don't know who's going to be the winner. You can buy a small proportion of each of them. So do the screeners and then do a sector approach rather than taking stock by stock approach, because that for a small investor is simply not scalable. So again, most of these companies have hit the market at a highly, I mean, they've already been, the cake has been fully baked. And wherever it's VC driven, where the founder owns 5%, 10%, the VCs call the shots. And understand this very important point, that if I'm a founder taking my company public, it's in my best interest to underprice an offering rather than overprice, because I'm not a seller in that offering. I'm raising capital. My continual flow of capital depends on how well my stock did after the IPO, not how well it did in the IPO. Correct. Or in the IPO, right? It's not the number of times it was oversubscribed. That's a vanity metric. The real metric is after it listed, did it double, triple in the next 2 years or 4 years' time? Because I'm going to need that tap of capital permanently to grow. For a VC, that's not at all a consideration. He's there to sell and take his carry and retire to the Bahamas. So you have to understand there are different considerations when these startups go public, because it's the VC or the bunch of VCs who call the shots with the bankers and not the founder. The founder is a little kid, you know, who just got lucky and he's got 7% in the company. He has no say in this anymore. Dubai being a global city, you know, we are fortunate to meet people from many, many different countries. And there's rarely a day when I don't come away, you know, feeling enthused about the fact that I'm from India and my field of play is still largely India. Because when you meet people from Sri Lanka, for example, I met a gentleman for lunch in Sri Lanka, last week, he's from Sri Lanka. The situation is horrendous. You meet people from Pakistan all the time. Situation is horrendous. You meet people from, obviously, Europe all the time. One of our major investors in a fund that we run is a German gentleman, old line hedge fund manager, now manages, basically allocates capital. And he told me that I think the country for the next 10 years is India. He's a 72-year-old gent, an old hat in investing. And he's never been to India, but he says that whatever I know, sitting at a distance, there is nothing that compares even remotely with this opportunity. So there is nothing not to like. I mean, it's simply at this juncture, and the flow of capital has so few good homes today in this world. You know, you can't go to obviously large parts of Europe because that's really been in a decline for decades. China is problematic. Japan, we all know, is up and down. Other parts of Asia are again in some sort of bother. US, while still being a great market, no doubt, still has its own problems and challenges with rate cycle and everything. Very few options left in this world, whether you're talking FDI investments or FII investments or even debt investments, than India. So it's just a beautifully sweet spot in the economic history of the world that almost every factor you want to look for in an investable market is right here in India. But this time it is different. There are 5P, 8P, 10P companies in the small cap space. They are definitely not going to go out of business in 10 years' time. I see very robust business models. The good thing is that the broad economy, while it is doing well, the growth is still patchy. For large companies, for example, a Lever or a let's say the banks, they need a far larger tailwind of economic growth for them to grow their numbers substantially from here. But for small companies, there is adequate pockets of growth available. You could be a regional snack food player and you can do $200 million in sales. I was reading an article in some paper that the spices market in India is $10, $12 billion. Spices, which is your daily, the stuff you put in food, and of that, most of it is unorganized. And now imagine that $10 billion has not even made its way to the organized players. That's the size. These are all small regional brands selling in Ludhiana or selling in down south and whatever. Yeah. That's the real opportunity in India, that you go hunting in the countryside, you will find companies who are like maybe $50 million in revenue, but they can go to 150 in 3 years' time. That kind of delta, I at least do not see happening for the larger companies. What I wanted to highlight was, I've seen over 25 years, the world has always found US markets to be expensive and India to be expensive. They found Russia to be cheap. They found some other markets to be cheap. And guess what, where it has led them, right? The thing is, these are quality markets with quality companies, and sometimes you have to pay up a bit for quality. You will never find greatness in low single-digit multiples. It's rare, you will, but not all the time. And therefore, we have to adjust our strategies rather than get fixated on a hard number that this is the P at which I like it or I don't like it. In India, there are quality companies. They have gone overboard like the levers and all that, but there are still, they still did a lot of good to most investors who bought in when they were 60p in the 90s. They continued being at 60p for 15 years. They delivered like 15, 18% CAGR in terms of their numbers. So these two markets, I've seen the world has generally said too expensive, we will not put a lot of money into it, and they are the two outstanding markets over 25 years. You take a look at ex-India and ex-US, look at all other emerging markets, largely disappointing or very not even rates of returns. But India, looking at the data, EMs, I think 4.5% CAGR over 20 years, India is like 9.5%, US is 12.5%. The gaps are like 2 or 3x relative to practically every other market. This is broad data, 25-year return. Just look at Indian returns, look at US returns. Those two are in one corner, and the other corner is all about negative returns or zero returns or 2% returns or 4% returns. 100%. I mean, I think, like I said, all the confluence of factors, just zeroed down on this market and this country. I mean, it's rare to have found that kind of a situation, but it is so.